Good afternoon. This is the Chorus Call conference operator. Welcome, and thank you for joining the DADA first half results conference call. After the presentation, there will be an opportunity to ask questions. At this time, I would like to turn the conference over to Mr. Lorenzo Lepri, CFO. Please go ahead, sir.
Thank you. Welcome to all of you. We are going to follow the presentation which has been uploaded on our corporate website in the section Investor Relations, which is called Conference Call H1 Results. We have at the board a couple of hours ago that has approved the H1 2017 financial reports, and we issued also a press release so we can make reference to that documentation. If you may, we would anticipate that the overall result of the first part of the year are quite satisfactory. We've reached a significant good result in terms of turnover, in terms of EBITDA margin, of operating cash flow, and we have improved most of all our KPIs. If you go through the very first part of the presentation, let's briefly focus on slide number 5. I guess you are quite familiar with what we are doing and where we are coming from. So H1 highlights from a financial and business perspective show that the positive trend that we've been seeing starting from last year is being confirmed also in the first part of 2017. Revenue have increased 7% to 35 million. As I said, it's the highest H1 results of the last 4 years, whereas EBITDA has increased to 6.6 million, which is the highest EBITDA of the last 7 years. EBITDA margin has increased. As you know, we are aiming at consistently increasing our operational marginality in the forthcoming future, and the margin was close to 19% in the first half of the year. EBIT has increased almost 30% to 3.3 million, and we closed the period with a positive net result of 1.3 million compared to the 0.4 million of last year. From a pure financial perspective, as I said, the operating cash flow contribution brought a positive reduction of our net financial position, which closed at 26.1 million as of June 30th, 2017, so an overall cash flow generation of 3.4 million, and within which we have recorded 7.1 million in operating cash flow, and the rest, of course, is capex and interest charges. A better financial results, which are mostly deriving from continuing improvement of our business KPIs. So customer base on a year-on-year basis has increased 8%. We've seen also in the last period still a significant increase in new customer acquired. We'll discuss that in the second part of this presentation. The increase is slightly lower in percentage compared to what was happening in the first part of the year and the end of the previous year, also because we started to do some selective marketing initiative in order to focus on more higher marginality customer bases and business and commercial initiatives, and all our customer or our market shares in all our geographies have even improved or have confirmed the market share. Let me skip to slide number 7, which shows how both the new customers acquired and the overall stock has been evolving on a period and on a year-on-year basis. As I said, we are keeping on recording a very good number of new customers which are entering, which is probably the most relevant metric we should be looking at. And the same is applying to the new domain registration. The domain, of course, is one of our biggest component in our offering portfolio, and therefore it's a good metric showing how now we are increasing in volumes on the market. Of course, as I said, we will tend to be as selective as possible from now on to focus on extracting the maximum value of our customers, also and namely on the most recently acquired customer cohorts, and therefore we will still report and record sound growth rates in both volumes and turnover, but we will try to focus more and more on the marginality of the customer rather than pure acquired number of units on a year-on-year comparison. Slide number 9 confirms what we said. As you can see, we've 35 million in the first half in revenue, and EBITDA increased 11%, EBIT 30%, and net result to 1.3 million. There hasn't been any material discontinuity in the business here, so I think the comparison is now very much, despite of course the impact of Sfera, we haven't accounted for any, let's say, extraordinary transaction which may have blurred the reading of these results. Slide number 10 shows, as I said, the quarter with the ampler time range, evolution of the EBITDA within the quarter on a highly longer time range, and as I said at the beginning, we are talking about the highest EBITDA in the last 7 years or so. Still, the international contribution to our overall turnover is more bigger than the domestic revenue, and we believe that international activities will still be an important part of our overall revenue and possible future growth. Slide 11 shows the waterfall in revenue. So as you can see, both our European and our UK regions have contributed positively to the overall increase in turnover. Sfera, which wasn't consolidated in the first half of 2016, accounted for 1.4 million, so it has contributed positively, and Sfera as well as Etinet are still delivering soundly and very well. So we are still very happy about these acquisitions. And the Forex impact accounted for negatively for 1.2 million. So that of course relates mostly to the depreciation of the British pound, which of course didn't take into account the impact of the Brexit that occurred in June last year. So we'll see how the exchange rate will evolve in the second part of this year, and to see whether we'll have a similar impact going forward, but I guess it won't be as significant as it has been in the first half of the year. As I said, EBITDA closed at 3.4 million, and the increase has been still impacted negatively, let's say, by a increase in cost of labor and in cost of commercial initiatives that were aimed at that have been aimed at increasing the customer base. So despite fostering growth and keeping the machine up and running and as efficient as it can be, we are still delivering quite satisfactory results, and the waterfall in slide number 13 shows quite in detail how the various contributors to our marginality have been impacting the first half of the year results. As you can see, product margin, which is of course a key metric for us, has increased organically 5.3%. We've had as I said, a more selective approach on some commercial activities compared to the previous year, which was aimed at creating an ampler customer base. So the cost of acquisition was slightly lower, 200K less on a year-on-year comparison. Cost of labor impacted, that is mainly because of the consolidation of Sfera, which wasn't taken into consideration, wasn't consolidated in H1 2016, and partially because we had a slightly higher number of headcount at the end of the year. We believe that our overall organization is quite well fit compared to the current ambition we're having, so we do not expect in the future to have any material further changes based on what we're seeing today. Sfera, as I said, contributed 0.4 million in the EBITDA, and the negative impact of GDP accounted for 200K negatively, so accounted 4%. Minus 4% in the overall evolution of the EBITDA of the period. So 6.6 million, it's 11%, more than 11% increase versus the EBITDA of the previous period, of the same period of the previous fiscal year. Slide number 14 shows also the waterfall and the comparison on the various aggregate which lie under or after EBITDA. So we're talking about depreciation, amortization, we're talking about net financial. Depreciation amortization is almost in line, slightly lower because of the long tail of the investment that have been carried and finalized in the last periods, whereas net financials, so financial charges, accounted for 1.3 million. Of course, there is a part of those, as you may be well aware, deriving from credit card commissions, which accounted for 0.6 million. This is also because we've been renegotiating part of the conditions with the merchants, so that despite having increased in volume, the overall burden for credit card has diminished on a year-on-year basis. And of course, we also have benefited from reduced interest cost thanks to the renegotiation of the long-term debt that was closed at the end of 2016. Taxes lie at 0.7 million. The increase, of course, is due to higher taxable income compared to the net taxable income reported in H1 2016. So we don't have any material changes apart from the positive contribution to our growth and marginality on a year-on-year basis that needs to be highlighted in particular. So I will skip slide 15, maybe slide, we'll skip 15, that was already commented. Slide 16 shows the delta and the composition of CapEx. We've accounted 1.1 million in R&D expenses, which is, I would say, a couple of 100Ks, not very 100, less than last year, 100K less than the same period of last year. and we expect this overall investment to diminish as well in the future. Dedicated servers, which is kind of investment that we do on behalf of our dedicated server activity, closed at 0.7 million, so slightly in line with the same date of the previous year, and the investment in hardware and software is 0.4 million. That compares to the higher amount in last year also because, as you may recall, we spent some investment for a tech refresh initiative, which was let's say more one-off investment for filers, which of course is a relevant disbursement that was needed to optimize some of our platform solidity and efficiency. So we don't expect any major discontinuity in the second part of this year. So it should be almost in line with what we've recorded in the first part of 2017. Cash flow, slide 17, operating cash flow closed, as I said, at 7 million, so 15% increase on a year-on-year basis. And I mean, we've already commented the disbursement we had in investing activities and financing activities, and as I said, the net financial position closed at 26.1 million, the composition of which is highlighted in slide 18, which shows the blend of the various duration of our debt. So you can see that we have a preeminent composition of medium long-term debt and a significant amount of cash in hand to offset on some short-term debt and still keep some buffer to either finance some activities, new activities, or some smaller acquisition that we might be working on, or to keep some financial flexibility in order to repay the future capital installment of our debt. The stock, I mean, I guess you are more familiar than we all are on how the stock has been evolving. Of course, we have highlighted also in our financial report that within the period we had our shareholder starting a process regarding the possible sale of the company, and therefore some discontinuity in the stock price and in volumes are now quite clearly related to this process that has been started now, I would say, at the end of March. And I don't have any news on that front to disclose as of now. We can focus probably on the last slide, which could be of interest for you, which is the strategic guidelines and the future strategy. We tend to be consistent with what we said at the end of last year. So our aim is to strengthen our European leading position, to do even better products and engage as well as we can toward the customer in a customer delight approach. We've been integrating, and we are finalizing the process of integrating our technological platform in one platform approach. So we are almost finalizing this integration of the technological product and marketing platforms, and we still are aiming at increasing the customer base. As I said, we will try to focus in the second part of the year on starting to extract more value from the customer base rather than just aiming merely at increasing the additional units, which we still will be doing, but probably at a slower rate compared to the first part of this year. We have very slightly updated our guidelines in order to anticipate that based on the actual 2017 results, we've got reason to believe that we may forecast for the full year an increase in top line of at least mid-single digit. Of course, that's always on a like-for-like basis. And we believe that the operating margin will increase more than proportionally than what the revenue will increase in percentage points. So we are seeing the very last period after the closing of our financial that as of now things are progressing very solidly and soundly, so we're quite happy about the trajectory the company is having. So we believe that this guidance fully reflects our, let's say, projections and our ambition for the year. So I don't know if there are some questions you want to ask. We are at your disposal to answer.
Mr. Lepri, there are no questions registered at this time.
Okay, thank you very much, and all the documentation is already online on our section, and I guess we'll be having the registration shortly as well. So if you need to go back to the what we said today, you can definitely visit our website, and of course we are always at your disposal in case you needed additional information. So hello to everyone, and happy holidays. Bye bye.